Good afternoon, everybody. I'm Dan Hussey with Zaner Ag Hedge, bringing you a strategy of the day update here for May 10th, 2023. Remember, trading futures involves risk and is not suitable for all investors, and everything I talk about here today is just my own opinion and not a direct trade recommendation. I kind of wanted to open the discussion today with the reversal we're seeing particularly in corn. We'll talk about wheat and beans as well. Keep it to those three row crops today. Maybe a little bit of cotton because I think something's going on there. We should pay attention to corn and cotton acres, or at least the pricing of which right now in old and new crops seem to be going a little hand in hand. New crop or old crop. Wow. Old crop soybeans is the strange animal here today. It's the only one that's been kind of struggling to get positive, where even new crop beans here are up a quarter of a penny. Kind of a weird day. Anyway, okay, so coming out of our last strategy of the week discussion, and certainly in previous videos we've talked about, right, this trend line on the corn, old crop corn here that broke, or this downward sloping trend channel, if you will, 10-day moving average at 588. We've failed to stay below it. Right now we're trading what could end up being an outside day reversal to the upside. We made a new low here for today's candle, reversing all the way through yesterday's high is an extremely bullish reaction here. And to me would be, the market making two steps forward and one step back in a very small short-term reversal structure. That would call into question, I think, a move up towards the 18-day moving average, which is at 603. I tested that $6 psychological threshold. And that $6 area, is this old, supportive area and the old gap fill here at $5.95 to $6 that we broke below, and we seem to be holding as resistance back into that area. We're back into the old range. We could go back to test the 55-day moving average at 617 and 637. That's what I'd be looking for. So today is an interesting reaction from the market. Something into the end of this week and into Thursday's strategy of the week webinar. Just to give you guys an idea of how I'm looking at this in the market right now. Looking at corn options here on the left-hand side. I'm going down to weekly options right now, right? Because these are pretty volatile markets. I see, the $5.95 and $6 thresholds as being significantly important. I don't think you need more than a week to get back above there. And for about 6 cents, just over the $6 calls through the end of next week, maybe even the 605s for a little less. But I think for around 6 cents here, they traded last, but bid at 6.18, offered at 6 3/4. That $6 call, to me, in terms of where, and let's bring up a chart of corn, in terms of a day trading strategy, kind of makes sense to me because, if you're going to put a stop below lows of the day, you got to have it all the way down at 579. That's, well over 10 cents. That's 14 cents away from where we are right now on corn. But to think that, okay, if we get above highs of the month here at $6, 606 is where you become profitable on the trade. That is 606 is closer, is almost closer, or it is closer to where we are right now than to lows of, the current market. So yeah, you could get long with the future, right? You might be selling into this resistance. I don't know, maybe that's your position. My opinion though, is that we're in the midst of a move that's going to take us up towards, $6 to 610. And we'll see what happens there. Oh no, I have to call them back here in just a minute. But point being is that a move up towards 608, the full 50% retracement off of highs, is probably in the works. So I think that option has a high probability of not only going in the money, but from where it is worth 6 cents right now, probably going to its break-even point, right? Because I think an upside target of 608 is pretty maturable by the end of next week. So if you're considerably higher, everything above there is now profits. So you can see how now options give you finite risk, a line in the sand, and a way to think that, okay, if a reversal's happening, there's a way we can take that. This gap that we saw, from yesterday's open, that was the opening bell. We gapped lower. We've now closed that gap. This looks like a very big island reversal to me on the intraday chart. So, right, we gapped lower. We've now reversed that island, and now we're taking out the entire decline. This market should, in theory, I think, head to 610 in a rather hurry. Hence why I'm pointing out these ideas right now, because by the end of this week, they're going to be old news, right? And that's not what we want to. That wouldn't do any of us any good. And we're going into a news report, right, by the end of this week with WASD, where I think we might see some changes here to balance sheets that might, surprise the market a little bit. So anyway, soybeans here in new old crop, again, struggling here at 14, 13 and 3/4, get through highs or get back to positive on the day, but have, once again, just kind of clambered on down, bounced off of that upward sloping trend line, bounced off the $14 handle. I want to see them get back above highs of the day and above 1420, above that 10-day moving average. Calls into question the test of the 18-day moving average up there at 1435. And then, of course, the 200-day, 55-day up there around 1460. I think we need to get back there minimally in beans before we really break below 14. But, that's all. We'll see. But certainly the reversal we're seeing intraday is helpful of that. Something I'm concerned about, though, here for soybeans is we did trade 3 waves up into a 50% swing from the 1501 April highs down to the lows after. 3 waves up here, traded into 1446, downside targets into 1366, and potentially to fill that open gap that has been on this chart here going back to, going all the way back. That's why it went to an hourly chart. There we go. Going all the way back here to July of last year at 1351. So if we break down below 1400, I think we're going that 50 cents lower, 1351, like I've talked about. But right now, I think we might be just in a range and coming off of 14. The next area, objective would be for a move back towards 1440. So like in corn, the beans into and through the end of next week, what does a 1440 or 1430 call kind of look like? And again, I'm trying to open people's eyes here to ways, other means of using strategies, right? Well, the 1446 highs would be 15 cents in the money for the 1430s, which are going for about 8. I think that's a little steep for an option that goes off the end of next week and is, almost 20 cents out of the money. But nevertheless, to see if, market will go above highs here, 4 3/4 to 5 cents for the 1440s. 9 days, we know the market could easily be, by the end of next week, could easily be at 1480, but we could also be down at 1400, which is why I'm advocating for the use of options in this environment, because things are volatile, right? We have a line in the sand where you could put stops below at 14. I think that, getting long futures with stops down there is probably somewhat advisable as well, because, if you are a buyer in this environment, because there's a clear line in the sand that if we drop below it, we could be going lower. To that same point, though, the $14 put is going for about 10 cents through the end of next week. I don't think that's a terrible idea either, with the intention that, hey, if we go below 14 by the end of next week, we could easily be down to 1350 or 1360, right? So there's definitely something on both sides of this market, and I feel like there's a few, right, and, everybody's been able to make money in this market. Bulls have been right, bears have been right in the last 2 weeks, but pigs, anyone who's married to a position is kind of getting kicked around right now. So keep that in mind, okay? So we'll keep an eye out on those ideas here going into the end of this week, and we'll certainly follow up with what we were talking about here into Thursday's Strategy of the Week webinar. So join me every Thursday at 1:30 p.m. Central, where I talk about these ideas in detail and a lot more, covering the whole breadth of the market and everything you see in front of you, more than just the row crops. Okay, so and last but not least here, let's take a peek at another chart that we haven't looked at in since last week or in the couple weeks before. Over the last year, pretty much been advocating and talking about how if you want to be a buyer in wheat, buy KC. If you want to be a seller, sell Chicago. Well, this ideology has come to an absolute apex with the Chicago KC hard red winter wheat spread trading to $2.18 over here. That is KC July wheat is at $2.18 premium to Chicago July wheat, and that is just a remarkable fact here over the last year. That the protein premium driven in this market is insane. Do I think this has gotten overdone? Do I think we should reverse? Absolutely. I think this is way too wide now. I was a bull this whole year on this spread for various reasons we've talked about before, which I don't want to get into because I only have a couple minutes here for this video. But generally speaking, this is not a market I would fade because, this is an environment where we refer to these types of spreads as widow makers, right? Boy, oh boy. Can they be very profitable if you catch it right? But look, sellers from 134 through 136 over have gotten run over to the tune of, 60 cents here. That is insane in a spread that, for the better part of the last few years was even trading at 60 cents under. with a premium of Chicago to KC. So, wow, spread markets this year are certainly where the activity is at, and I wanted to point everyone's attention to that. Chicago wheat, though, 18-day moving average is still resistance at 654. 10-day moving average here at 638 seems to be supportive. I think this market pulled, made 2 steps forward and 1 step back into 50% longs. As long as we're above 630 for Chicago wheat, I'm kind of bullish, and certainly through highs of today calls into question 18-day moving average. Above that, we're going to the 55-day at 688. 100-day at 725 and 200-day at 768, or 786. Excuse me. I think July wheat. That's only 50% back of like this last leg lower. So I think we do have it in it to get up to 8 eventually. Those are my bigger time frames. But on the small time frame, and we'll look at KC here in a minute and wrap things. On the smaller time frame, the 4-hour chart here, this is that 2 steps forward, 1 step back I was talking about, that 50% long Chicago wheat traded into 636. We've defended the 628 line. Upward swing targets towards 684. That would take you back into the old range that we broke down out of and below from the March and April low here. We broke through it in April. We made a new low in May. May has started to reverse, made 2 steps forward, 1 step back. The thing about May and this price action, though, from the 735 highs to lows, there is a 50% short there at 669. That is also, where the markets run into. So we need to kind of be aware that sellers have a 50% to 618 line area of resistance. Buyers have their own down here, and it's going to be a fight over the trend between 630 and 670 until it breaks. I think we're going back above 670, going back into this old range, going above this downward sloping trend line. You can see how the built-up short pressure into this market starts to get alleviated, and that's what starts the short covering rally above $7 in Chicago wheat. If it gets there, I think you get back to $9 quickly, $8 and $9 quickly, but that's a lot, there's a lot that needs to happen here before then, and you can't deny the last couple of days we've had lower lows and lower highs. So we break below 630 and we reverse today. We don't get through highs of the day. This looks very bearish because don't forget that 50% short in the highs it's at 770. They got downward swing targets of 572. So we'll see who's going to be the winner, so to speak, there. KC wheat just won't sell off, though. Much different than the Chicago wheat. That same 50% swing here from the April highs and what have you did not hold. It's basically coming all the way back up to 50% in its decline from $10 all the way down. So, okay, running into upward slope trend lines maybe against the highs here as well. But certainly the last 24 hours, KC wheat has said we are not going lower. Didn't even make a lower low and lower high. In fact, we're making higher highs and higher lows still for KC wheat, something the Chicago contract has yet to do for the day. So, boy, does this chart look bullish. It's so bullish it's not even pulling back yet. And I'm wondering if it's not going to knife to $9 to $9.20 before pulling back. And if it does, be prepared for a big dip if it happens. And, we'll all be talking about what to do then. But intraday here, KC wheat signaling to the rest of the wheat complex, nope, not going to happen. Not today, not the sell-off. So thanks for joining me, everybody. You can always reach me over here at Zaner at 312-277-0110. Find me on Twitter at Hussey, Daniel Hussey Jr., or Dan SOT on Facebook. And shoot me an email, dhussey@zaner.com, with any questions or comments you might have. Leave them in the sections forum in this video. And join me every Thursday at 1:30 p.m. Central for the Strategy of the Week webinar, again, where I'll cover all of this and more. Have a great day, everybody, and we'll be back with you as price action develops. Take care, everyone.